The state of the economy, layoffs, troubled banks, and high interest rates. The year has not started off well for the economy, with significant layoffs, troubled banks, and high interest rates. In the next few minutes, we will delve into the reasons behind these developments and their implications for the economy. We will discuss the recent layoffs in various industries, the troubles faced by New York Community Bank, and the overall state of the economy. Additionally, we will explore when the Federal Reserve might lower interest rates and the potential impact on the economy. Layoffs in various industries. The year has witnessed a wave of layoffs across different sectors. Companies such as Amazon, BlackRock, eBay, Google, Macy's, Microsoft, PayPal, and UPS have announced significant job cuts. The tech industry, in particular, has been heavily affected, with over 65,000 job losses planned at the start of 2024. These layoffs can be attributed to various factors, including economic pressures, corporate spending constraints, and the impact of the pandemic. Troubles at New York Community Bank. New York Community Bank has recently faced significant challenges, leading to a 40% drop in its stock price. The bank's troubles stem from its heavy investment in commercial real estate loans, which have been adversely affected by the rise in vacant office spaces. Additionally, a large portion of the bank's loans are coming due, requiring refinancing at higher interest rates. Furthermore, the bank's acquisition of Signature Bank has increased its assets under management, AUM, to over $100 billion, necessitating higher reserves. These challenges have raised concerns about the bank's solvency. The impact of high interest rates. One of the primary reasons behind the current economic challenges is the high interest rates set by the Federal Reserve. The Fed's decision to increase interest rates in previous years has led to the current situation. The high rates have put pressure on corporate spending and job stability. Unfortunately, the Fed has indicated that it will not lower interest rates in the near future, exacerbating the economic challenges. Predictions for lowering interest rates. According to the CME FedWatch tool, there is a 34.5% chance that the Federal Reserve will lower interest rates at its next meeting in March. However, the more likely scenario is a rate cut at the following meeting in May, with a 62.3% chance. Even if rates are lowered, the decrease is expected to be minimal, potentially leading to further layoffs. Historical data suggests that when interest rates reach a peak and start to decline, it often precedes a recession. Conclusion. The current state of the economy is marked by layoffs, troubled banks, and high interest rates. The wave of layoffs across various industries, including the tech sector, has been a significant concern. New York Community Bank's challenges highlight the risks associated with heavy investments in commercial real estate loans. The high interest rates set by the Federal Reserve have put pressure on corporate spending and job stability. While there is a possibility of interest rate cuts in the future, the impact may be limited. It is crucial for individuals to be cautious with their spending, focus on building a cash cushion, and consider diversified investment strategies.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.